Let's talk about investing and tell people why. Do you want to stay away from these interval funds? I'm sure your brokers try to sold them to you. They've been sold quite a bit. I've been seeing more and more of these interval funds when we take over accounts for new clients. And let me tell you, we are not a fan at all of these. They appear to be like normal looking mutual funds, but the key is when you go to sell them, well, you find out you can only sell once per quarter. What?
Yeah, and I've seen this now many times, and it comes over, and you're like, oh, okay, great. Yeah, we can get into the way we want to manage money, especially it's very irritating in IRA because you don't even have to consider tax considerations. And you're like, oh, and then if you miss that date once per quarter, well, now you got to wait a whole another 3 months before you can even try and sell it again. But the other problem is when you enter the sell, the next day you realize you still own shares in the fund. Why is that? Well, the products have a unique structure that typically allow investors to just redeem 5% of a fund's assets. So let's say every single shareholder out there wants to redeem shares in that fund. You'd only get 5% of what you own in that company. And the problem is you're getting smaller and smaller, right? So your pro rata allocation in that, you might sell, let's say, $5,000 one quarter, but now since you have less, now you're only selling $2,000. So it gets smaller and smaller, and you're not getting out of it. I mean, it's just terrible.
You're always going to have something because your pro rata always stays low. So they'll keep you forever. You're married to those guys forever. So stay away from them. And I'm sure most people have no idea that their advisor or themselves have actually got these funds, and you're locked away for years. And for example, I first saw this about 4 years ago, the new client, and this was 4 years ago, we're still not able to get out of completely that fund for what you just talked about. You keep getting the percentage amount, which is small and small. I mean, that can go on for an infinite time frame.
Yeah.
Yeah.
If other people want to cash out, you're screwed. Yeah. Now, if you're the only one cashing out, you can get out, but I mean, it's a pain. And I mean, I understand why the withdrawals are limited. Not that I agree with it, but the reason they're limited is because the funds generally invest in our favorite things, illiquid assets. So managers want to make sure investors can't exit en masse and force the manager to sell securities at fire sale prices. So, I mean, that's why they do it. I understand it, but we would never recommend investing in illiquid assets to begin with. This is just another illiquid asset.
And I think that's a taste of the future problems to come. When you have a major problem, major recession, and those assets are illiquid, there's going to be some major problems. And the interval funds are just a beginning.
Well, I mean, we talk about this all the time with illiquid assets. The problem is when it's going up, it's fine. You don't really care. You don't want to sell because things are good. But things turn and go south. They're still illiquid. You can't get out.
You can't get out of them. They're liquid. And the allure here for many is that retail investors with less investable assets generally don't have the same access to this as many private equity, venture capital, real estate, and private debt deals. So interval funds enable people to get those with a minimum of maybe $1,000. You get exposure to this space, which I don't think is a good thing. And I would not recommend these all. What really bugs me on these is where they're sold like, well, this is what the wealthy's doing. Yeah. So here for $1,000, I can sell you this and you can invest like the wealthy. No, I hate that. If you hear that, walk away from your broker because he is selling you a product.
We have many wealthy clients.
Yeah.
None of them are in these, so don't feel like you're missing the boat.
And some have had them, and they got burnt on them, and they go, I don't ever want those again.
Let me rephrase that. We actually, I think, have 5 of these funds in our portfolio
that we can't get rid of.
We can't get rid of them.
And they want to get rid of them, and they're terrible performance.
I mean, I will say some of them have done okay, but just because something's done okay doesn't mean it will do okay going forward, and we'll get into that. The issue I see with these funds that a lot of people don't realize is the fees. They're just insane. I mean, Morningstar, they looked at 307 interval fund share classes that are currently available. Get this, the median fund's total expense ratio is 3.02%. So if you're paying an advisor, let's say 1.5%, you're paying 4.5% essentially to have that fund. And a big reason for the high fees is they include the cost of leverage, which these funds use in many cases to amplify the returns. Wow, that sounds good, right?
That's great.
That doesn't sound risky or anything. I mean, goodness. But even if we include the cost of leverage, the median expense ratio is still 2.18%. I mean, these funds are just, wow, you're getting raked over here, and Wall Street is getting the ones that are making money from this.
And I'm sure when that product sold to you about, the wealthy are doing this, know what they tell you. And by the way, the fee internally that you won't see is 3%. I don't think they'll ever say that. No.
Sure not.
And actually from Morningstar, Brian Moretti He's a fixed income strategist team. Had some interesting things to say researching the space. He concluded before deducting any fees or incorporating any leverage, there was little difference between private credit interval funds and public bank loan mutual funds and exchange traded funds. And we've done those private bank funds before, public bank funds before. However,
no private bank funds. We only do publicly traded securities.
Yeah, I think the senior floating rate funds. And that's kind of what these are. And as I said, interval funds have beaten traditional loan and high yield bond funds as they had about 1.3 times exposure. And you kind of talk about this on average to such debt in a rising market. But that's in a rising market. Markets don't go up forever. And just think about this. Yeah, that 1.3 is great when things are going up. It reverses when it goes down. It's going to have you lose more money quicker. And by the way, you can't get out because, sorry, it's not the right quarter. You got to wait for the quarter to end. And you can only take 5% as you see these things dropping and dropping.
Yeah, I mean, it's terrible. So I just want to kind of reframe that. I mean, the only reason, essentially, according to Mr. Moradi's research, that these funds are outperforming is because of the use of leverage. It's kind of like if you have a doubly levered S&P fund, let's say. Well, yeah, of course you're going to beat it in a rising market.
Right.
But all of a sudden things go down. Now you're losing twice as much.
Yeah.
Maybe even more because they use derivatives. This is potentially a similar issue. And leverage is terrible for people long term, in my opinion, because things are great when everything's fine, but all of a sudden that dime flips. Leverage destroys people. Yeah. It destroys investments. It destroys consumers. Being over leveraged is a huge problem. And I saw that. I was like, wow, that is not good. I think we could have a potential leverage bubble in many of these different asset classes.
Oh, I no doubt about it, because it is going to happen. We go through these cycles. Right now, we're in kind of the boom cycle. It's going to reverse. And when it reverses, people will lose billions of dollars.
Potentially everything. Yeah. If you have leverage, you could lose everything.
Yeah. And I do worry about the future. I think it could make 2008 look like a...
It seems the leverage is more hidden this time around. I keep reading these different things, and you wouldn't see leverage on the surface, but you dig in and you see more leverage in these different products that you weren't aware of on the surface, and that to me is very dangerous.
Well, it's like the CMOs. They were kind of hidden as well. So all this stuff is hidden, and it will come back. You'll have to pay the piper eventually.